The housing market is a paradox in the UK economic recovery. A revival in mortgage demand, spurred on mostly by the Bank of England's record low base rate, has helped drive the wider recovery. But spiralling house prices and bloating mortgage debt are two of the biggest risks to the economy. The week started off the back of a warning from the IMF that the Bank of England should step in and place a loan-to-income cap on the market. That would mean banks could only lend out an amount that was a maximum of a certain number of times the applicant's income. For example, capping a loan-to-income multiple at 4 times would mean somebody earning £25,000 a year could only take out a £100,000 mortgage. This would help prevent lenders allowing borrowers to stretch themselves too much financially to take on a mortgage. In turn, this would put the brakes on house price growth. The ONS said the average price of a UK home was £252,000 in March 2014, after jumping 8% over the year because of higher demand. The problem here is that as people take on bigger mortgages to pay for the higher house prices, their monthly repayments get bigger too. And this issue becomes even more concerning because of the Bank of England's ultra-low base rate, which has depressed mortgage interest rates. When the Bank of England hikes rates, which will likely be in 2015, it may push those borrowers who stretched themselves while credit was cheap to default, sparking another crisis in the housing market. A survey by YouGov carried out on behalf of consumer group The Homeowners Alliance found that 34% of property owners fear they will not be able to afford repayments when interest rates rise. And this increases to 49% of homeowners between the ages of 25 and 34. Lending is still on the rise too. The Council of Mortgage Lenders said the number of mortgage approvals for home purchases hit 53,200 in April 2014, a whopping 33% increase over the year. So house prices are rising strongly, and so is mortgage lending, inevitably meaning households are becoming more indebted, leaving the UK open to an interest rate shock when the Bank of England makes its move. Now the UK's Business Secretary, Vince Cable, has stepped in. He said he was appalled to hear that some banks were lending out mortgages of 5 times the applicant's income, particularly in London and the south of England, where property prices are particularly high. A multiple of 3.5 is much healthier, he added. Cable joined the IMF in urging the Bank of England to step in and curb the loan-to-income multiple, else risk the housing market destabilising the whole economy. With increasing calls on the Bank of England to take action over the mortgage market, it looks inevitable it will do something. Its Financial Policy Committee meets again in July, and we may hear a significant announcement from that. Thanks very much for watching, and for more business news, go to ibtimes.co.uk/business.